What kind of life insurance should I get? This is one of the common questions I get, and in this video, I'm going to go over the main types of life insurance and how to decide which one you should get based on your needs. Hey, welcome back. My name is Gilbert with ZA Financial. We believe that the more informed you are, you will be able to take the right decisions for yourself and for your family. This is why we focus on transparency and education around life insurance and financial products in general. Never ever feel rushed into getting any financial product without fully understanding it. Life insurance policies can be broadly categorized into two main types based on the length of coverage. We have term insurance and permanent life insurance. Now, term life insurance provides coverage for a specific term, typically 10, 15, 20, or even 30 years, while permanent life insurance provides lifelong coverage. So let's look a little bit more into each of these. With term insurance, as I said earlier, it provides coverage for a specific term. It offers a death benefit that is paid out tax-free to your beneficiaries should you pass away during the policy term. Term life insurance policies do not accrue cash or provide coverage beyond the policy term. However, they can be renewed or converted to permanent policy, allowing you to extend the coverage. Term life insurance is often more affordable compared to permanent life insurance, making it a popular choice for individuals with temporary financial obligations, such as having mortgage, car loans, or even young children who will eventually become financially independent. Permanent life insurance, on the other hand, covers you your entire lifetime. It combines a death benefit with a cash value component that grows over time. It typically has higher premiums than term insurance, and it's ideal for individuals who want to use their life insurance policies for more than just the death benefit, such as tax diversification, risk management, liquidity, and business planning. I've covered all these points in details in one of my videos entitled, "Should I Buy Life Insurance?" I'll put the link in the description below, so feel free to check it out. Under permanent life insurance, we have whole life insurance, universal life insurance, variable life insurance, and final expense insurance. Universal life insurance is sort of an umbrella of different types of insurance products. Under that, we have the traditional universal life, guaranteed universal life, indexed universal life, and variable universal life. This might seem like a lot, but by the time we go through each of these, you will know exactly which one to choose based on your needs. Now, the differences between the various types of permanent life insurance have to do with how the cash grows, how flexible the premium payments and death benefit can be, and also the guarantees the product offers. So as we go through the various types of insurance, we will be evaluating them against these points. Now, let's take a look at the first type, which is whole life insurance. Whole life insurance guarantees level premium, meaning the cost will remain the same throughout the life of the policy. It also guarantees cash value growth, which means the cash in the policy will grow over time. Depending on the company and product, whole life guarantees a cash growth rate of 2% to 3.75% plus non-guaranteed dividends. At the end of the year, when the insurance company makes profit, they will declare a dividend which is paid on top of the guaranteed rate. You need to understand that the dividend is not guaranteed. Whole life also guarantees the death benefit, which means should you pass away and the policy is in force, the amount will be paid out to your beneficiaries. Now, when it comes to premium payment, whole life is less flexible, especially in the early years. Over time, when the policy builds enough cash value, coupled with dividends, you could use it to offset some of the costs. The growth potential in whole life is considered to be on the low side as compared to the other types of life insurance. This is because the growth in whole life policy depends on the performance of the insurance company. Since insurance companies are all about risk management, they are usually conservative. Also, because of the guaranteed growth in the whole life, risk is considered to be low. The next type of permanent life insurance is universal life insurance. As I mentioned earlier, universal life is sort of an umbrella of different types of permanent life insurance with slightly different features. Universal life insurance tries to promote flexibility when it comes to premium payment and the death benefit, allowing you to increase or decrease it. As you know, when we have options, that's when our problems begin. This flexibility can make or break a policy. With flexibility comes all sort of issues because people either forget or assume the cash in the policy will grow to a point where they don't need to make any payments. As a result, any form of universal life insurance requires proper management. Under universal life insurance, we will look at 4 types. We have traditional universal life, guaranteed universal life, index universal life, and variable universal life. The main difference between these are how the cash grows in the policy. So let's start with traditional universal life. There's a lot of flexibility when it comes to this product. You can increase and decrease the death benefit. You also have flexibility in terms of the payment of the premium. The insurance company deducts the expenses on a monthly basis. So as long as you have enough cash in the policy to cover the expenses for the month, your policy continues to be in force. The insurance company doesn't really care how and when the money is paid into the policy. With traditional universal life, premium, expenses, and death benefits has little to no guarantee. Although the expenses, specifically the cost of insurance, can change, the contract usually declares the policy maximums. The account value grows through interest credited based on the current market. Now, because the growth depends on the interest rate set by the insurance company, it will require a high interest rate environment to do well. With little guarantees, a traditional universal life is riskier than whole life insurance. The second type of universal life insurance is guaranteed universal life. This product was created to provide some guarantees, hence the name guaranteed universal life. It provides guaranteed death benefit and guaranteed premium up to a specified age. So when you are getting a policy, you will be required to choose an age the coverage should end. The older the age you select, the higher the cost. Guaranteed universal life is not intended to generate significant cash value over time. Its emphasis is on providing guaranteed death benefit. Guaranteed universal life is generally less expensive than whole life and traditional universal life. You can think of it as sort of a permanent term insurance because it accumulates little to no cash. It has the lowest risk among all the universal life products. Because of the guarantees, the payment of premium is not really flexible like the other type of universal life insurance. This product makes sense if your main focus is permanent death benefit without all the bells and whistles. The next type is Index Universal Life, popularly called IUL. IUL is very similar to traditional universal life, with the main difference being that the method for crediting the interest is based on the performance of a stock market index. A market index tracks the performance of certain groups of stocks, bonds, or other investments. Think of S&P 500 or Dow Jones Industrial Average. So when you start a policy, you are going to choose an index, and based on how the index performs, the account value is credited accordingly. One thing to be aware is that the money is not invested in the index, so there is no market risk. IUL has a higher potential than whole life. Again, the word is potential. Nobody really knows how the market will perform. Now, because there is little to no guarantees, it is also riskier than whole life, but less risky than any of the variable products due to the zero flaw protection. I will have a separate video for IUL in detail, and When I have it ready, it's going to be in the description below. The last type of universal life product we are going to look at is the variable universal life, VUL. The cash in the variable universal life grows based on the returns of the underlying investment account. Now, because the money is actually invested in the market, the growth potential as well as the risk is very high. You better know what you are doing before getting this kind of policy. Variable universal life offers the flexibility to adjust death benefit as well as premiums, but it offers little to no guarantees. Because of the risk involved, only a security licensed agent can sell this product. Variable life insurance makes sense to someone who believes he or she is good at picking stocks and wants to take advantage of the tax benefit in an insurance product. So now that we've covered all the different types of universal life, the next type of permanent life insurance is variable life insurance. Variable life insurance has a lot of features similar to variable universal life. Account growth is based on the returns of the underlying investment account. Now, anytime you hear the word variable being associated with a life insurance product, think of a portion of the premium being invested in the stock market. Hence, a security license agent is required to sell it. One of the main differences is that it lacks the flexibility of variable universal life. Variable life insurance typically has fixed premiums as well as guaranteed minimum death benefit. Because there is less flexibility, it requires less ongoing policy management as compared to variable universal life. The growth potential as well as risk is high because the money is actually invested in the market. The last type of life insurance policy we are covering is final expense life insurance. Final expense life insurance is a whole life insurance with smaller coverage. It is specifically designed to cover the costs associated with a person's funeral, burial, or related expenses. Coverage amount will usually be about $35,000 or less, although this can vary slightly. The premium is typically level, and as far as you continue to make your payments, you have coverage for life. Since this is a whole life insurance, the risk and growth potential are low compared to other permanent life insurance policies. So now that we've covered all the types of life insurance, I know it was a lot. Let's look at scenarios and how we're going to decide based on a person's needs. Scenario 1. John is 30 years old with 2 children and wants life insurance coverage because he just bought a home with a 30-year mortgage. He doesn't want to burden his family with a mortgage should he pass away suddenly. Now, John doesn't plan on using his life insurance to grow his money as he believes the stock market will produce far more returns. Once he's done paying his mortgage, he believes his children should be in a position to take care of themselves. So we can see that John has a temporary need of protection while paying off his house. As soon as he's done paying off the house, he no longer needs the insurance protection. A 30-year insurance will work in this scenario. Alright, scenario number 2. Take a guess, follow through with that, and I'm sure you are going to get it right. Jennifer is 62 years old with 3 children. The last thing Jennifer wants is to burden her family with expenses should she pass away. She has therefore decided to get a life insurance policy to cover her burial and related expenses. She doesn't plan on borrowing from her policy. So with Jennifer, she has a specific need to cover burial and related expenses. So it's pretty straightforward. A final expense life insurance will work in her scenario. Scenario number 3. Ken is a 33-year-old savvy businessman who considers life insurance as an asset. His plan is to incorporate life insurance as part of his overall portfolio. He plans on borrowing from his policy to fund business deals that come along the way, but while the money is not in use, he is okay earning a conservative rate of return. His mantra is slow and steady wins the race. He prefers guarantees over any potential growth. Term insurance doesn't work in this scenario. Because Ken Labs guarantees, most of the universal life product will not work. The only product that has guaranteed among the universal life family is the guaranteed universal life, but that does not build much cash. In his scenario, whole life insurance will probably meet his expectations. It offers guaranteed and also allows you to borrow from the policy. So Ken might more than likely work with a whole life insurance. Scenario number 4. Mary is an expert trader who recently learned she could buy stocks in her insurance account while enjoying the tax-free benefits it provides. She believes that due to experience, she can perform better than any interest the insurance company can credit. In fact, she has earned double-digit returns for the last 6 consecutive years. Mary prefers to have some flexibility as far as premium payments are concerned. So with Mary's scenario, term insurance is not going to work. There's no cash in it. Mary wants to be in the market, so she needs some form of variable product. Now, because Mary also needs flexibility, variable universal life might work in her scenario. The next scenario, scenario number 5. Chris wants an insurance with lifelong coverage while paying the lowest premium possible. He doesn't care about taking loans from the policy or cash growth. As far as he is concerned, if you want to grow your money, there are only 2 options. Either you are in the stock market or you have a business. He doesn't believe in commingling life insurance and growth of his money. In Chris's scenario, term insurance doesn't work. Because he needs some sort of a guaranteed death benefit, our options will be whole life insurance or guaranteed universal life. Between these two, guaranteed universal life will typically be more cost effective. We usually run the numbers and make a decision accordingly. Scenario number 6. Sarah is a 40-year-old who suffered severe losses in the market and has decided to take a conservative approach using life insurance. She wants the potential to earn market-like returns while being protected from losses. She plans to supplement her retirement income using cash from her life insurance policy. So in this scenario, none of the variable products will work because she doesn't want to be in the market. Also, because she wants market-like return, IUL will probably work in this scenario because IUL offers market-like return while not actually being in the market. So the next time you find an agent telling you, oh, buy IUL or buy whole life or buy term and invest the difference without knowing your needs, you have to question their motivation. When it comes to life insurance, there is no general advice. Your specific needs should dictate the type of product selected. Hey, if you got any value out of this video, please click the like button and subscribe to my channel. You can also hit the notification bell for future videos. Now, if you are considering getting a policy or need a third party to review an illustration you have, feel free to reach out to me. My contact is going to be in the description below. Thank you so much for your time, and I'll see you again in the next video. Bye.